Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at financial results and we're turning our attention to the conglomerate sector of the Trinidad and Tobago Stock Exchange. And of course, we're looking at two very local giants in this particular sector. We're talking, of course, about Ansa McAL as well as Massy Holdings Limited, or both groups that have reported earnings, which were somewhat contrasting in terms of fortunes for their respective investors. Let's take a look at what would have taken place and what investors might expect in the coming months ahead. Turning firstly to Ansa McAL, well, the group would have reported for its fiscal half-year period of 2026 a whopping 50% increase in its earnings per share from continuing operations and overall of $1.50 compared to that $1 in the prior comparable period of the fiscal half-year of 2025. Now, revenues are up a fairly modest 2.8% from $3.68 billion to just about $3.79 billion. However, most of the magic took place in terms of increases in operating efficiency, with operating profits increasing 12.3% from just over $400 million to around $450 million over the comparable periods. Finance costs also decreased over the comparable periods, roughly 18.5% from $101 million to just about $83 million, resulting ultimately in profits attributable to equity holders of the parent company of $257 million versus that $171.8 million in the prior comparable period, that 50% odd increase. When we take a look at Ansa McAL's profit before tax performance by segment, some fairly notable changes. Banking and insurance up a whopping 32% from $97 million to just about $128 million over the comparable periods in that bluish segment. Automotive trading and distribution facing some period of weakness, of declining actually just about 25% in terms of PBT, from $77 million to just about $58 million over comparable periods. Construction, manufacturing, packaging and brewing, that particular segment in pink, up just around 8.4% from $226 million to $225 million, and a narrower loss in the media services, retail and parent company segment, from narrowing from a loss of $77 million in the prior comparable period to just about $30 million in the most recently concluded fiscal 6-month period. Now, from a operating profit margin perspective, we can see that there was significant improvement. Operating profits hitting its highest level, in fact, over the past 5 consecutive periods at the half-year point, just around 11.9%. Profit before tax margin also improving fairly significantly and resuming or returning to its high levels of 10.6% over the all-time highs over the last comparable 5 particular periods, or 5 comparable periods, at again that 10.6% level. What that means is the group is finding it easier, managing to operate more efficiently and more profitability per every revenue dollar earned. From a valuation perspective, we can see that the share price has languished somewhat relatively over the past 5 comparable periods, currently trading at around $47. But with that trailing 12-month earnings per share figure consistently improving over the past few consecutive periods, currently at around $3.95 per share. Again, that trailing 12-month EPS, with that improvement combined with the decline in share price, would have resulted in a more attractive relative valuation for the Ansa McAL stock, currently trading at around that 11.9 times earnings. Again, at that $47 price and that 11.9 times earnings, excuse me, Ansa McAL is trading broadly in line with the conglomerate sector average of 11.5 times, with a dividend yield again of 0% compared to the sector average of 4%. Of course, the temporary suspension of dividends for a 3-year period, part of the group's strategy as it moves to increase its acquisition and geographical diversification initiatives, leading to those ultimately strong operating earnings that we are beginning to witness, as well as that modest revenue growth. And with those factors in mind, Bourse is going to maintain its market weight rating for the time being, with a positive outlook, however, for Ansa McAL. Turning very quickly to Massy, for its fiscal 9-month period of 2026, the group would have reported an earnings per share figure of 16.3 cents per share rather, which was a 35% decrease in that earnings per share figure over the comparable period of 25.3 cents in the prior comparable period. EPS from continuing operations also declined just about 9% from 24.6 cents per share to 22.4 cents per share. Revenue from continuing operations did increase 6.8% from $11.8 billion to just about $12.65 billion equivalent. Ultimately, however, profit attributable to equity holders declined at 35.6% over the comparable periods from 500 million to just about 322 million. Driving this performance was a fairly mixed result in terms of its profit before tax contribution by segment. Integrated retail, for example, its largest segment would have been fairly flat at around $514 million in PBT contribution. Gas products down just about 3% from $275 million in 9 months of 2025 to just about $267 million in that 9 months of 2026. Fairly notable improvement of around 12% in that motors and machine segment, growing from 128 to 140. And a notable decline of roughly 21% in that financial services segment, its smallest segment, declining from 57 million in PBT to just about 45 million in PBT over the comparable periods. Now, from a profit margin perspective, we also note that there was some deterioration in margins for Massy over the comparable periods. Operating profit margin, for example, down at 6.1% in that yellowish line, down from 6.7%. Profit before tax margin also declined from 6.8% in that pinkish line to 6.2%, and ultimately profit after tax margin also declining from 4.5 to 3.9% in that greenish color. Now, from a geographical composition perspective of profit before tax, we can see some notable changes. Trinidad and Tobago continues to decline in terms of relative importance to the group's PBT, moving from 33 to 32%. Guyana, in that orangish color, improving from 27 to 30%. Jamaica and the USA, one of the most notable observations, would have actually declined in relative importance from 8 to 6% in the case of Jamaica and 3 to 1% in the case of the US. These jurisdictions would have been home to some of the more significant recent acquisitions of the Massy Group. Colombia increasing from 5 to 7% in that brownish color segment. So at a price of $3.43 per share, Massy is trading at a price earnings ratio of 10.2 times, slightly below the sector average of 11.5 times, and offers investors a fairly attractive dividend yield of 5.2% relative to the sector average of 4%. So with revenue growth in mind, continued geographical diversification, however, keeping an eye on those lower profit margins in the near term, Bourse is going to maintain a market weight rating on Massy for the time being with a stable outlook. Well, that's it for this week's edition. For more information, you can give us a call at 2BORSE or 226-8773. Email us at info@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And you can catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, enjoy your independence holiday, and we'll see you again on the Bourse Report.